Hello, everybody. My name is Paul Buitink, and after a long period of absence, finally, here's a new episode of Reinvent Money, in which I talk to a broad range of monetary specialists. My guest today is a former entrepreneur and owner of Monetary Metals, Keith Weiner. And Keith is a strong advocate for a gold standard. I'm going to discuss with him how gold standard systems work, why was it abandoned in the past, and also how likely is it that the BRICS nations are going to introduce one. And also would be interesting to hear his opinion on Bitcoin and a Bitcoin standard. So Keith, welcome.
Thanks for having me, Paul.
Yeah, so there's a lot of buzz about the BRICS summit end of August in South Africa and whether or not they are going to introduce a new currency, possibly backed by gold. What's your take on that?
Well, I think the first question is, what do they really want? And I think I get to say this having done a lot of travel around the world and spending time not just in touristy things, but talking to people in the gold business, in some cases talking to members of parliament and government officials. The world has a love-hate relationship with the dollar. They definitely don't like the dollar because the dollar, causes them harm. But when it comes to their own, finances, you talk to pension funds in the Middle East or in Southeast Asia, the balance sheet is denominated in dollars. So there's kind of a funny love-hate relationship. And that's one of the reasons why the dollar system has been so, I'm not going to use the word stable, but we'll call it pseudo-stable for many decades. And I don't think that dynamic's really ready to change. I tweeted the other day that, the fox, after jumping and jumping and jumping to try to get the grapes, finally declares them to be sour. Putin is now saying that, the dollar is finished because he's locked out of it, right? But, in terms of a gold standard, the gold standard is the monetary system of a free market. It's not the monetary system either of, rapacious dictatorships or socialist welfare states. So who actually wants a gold standard is the first question. And when you look at the countries in the world, the so-called BRICS, you would think would be the least likely candidates. They have capital controls, right? It's illegal to take your money out of China. It's illegal to take your money out of South Africa. It's illegal to take your money out of India. It's illegal to take your money out of Russia. I think Brazil does not have capital controls, but that would be the only one that is actually has an open, capital account. Number two, all the top people in government and in the monetary authorities and central banks, they're all Keynesians. They all study in the same, programs, whether it's Harvard, whether it's Berkeley, whether it's Chicago, whether it's London School of Economics. They all go to the same places and they all learn the same dogma. So to say that suddenly they've got gold, I kind of really question that. And then thirdly, the problem is how do you declare a gold standard? It's not something that, the original gold standard was never declared as such. People value gold, they still value gold, of course, and they were using gold in a way that the government hadn't made illegal until essentially the eve of World War One, and then all the various countries went off gold for various degrees and various timings, between, let's say, 1913 and the 1930s was the end of it. You can't take an irredeemable currency which has been borrowed into existence as an irredeemable currency and then retroactively declare it, oh, now it's gold backed. Well, it isn't. It never began life as a gold deposit. A proper gold currency begins life as when someone's depositing a gold coin and getting a currency as essentially a receipt, which is the right to have your gold returned to you, or you could pass that piece of paper to somebody else and it becomes his gold and he has a right to have it returned. But today, there isn't any gold like that. So they buy gold and they think, oh, we have enough. But there isn't any such thing as enough. You've never earned the trust of the people. And that's the real issue, is trust. People will deposit their gold if they trust the rule of law and that they have a right to return it. And they won't deposit their gold if they think that this is a politicized decision-making process. And so it ends up becoming nothing more than a price-fixing scheme where some central bank says we are going to fix the ratio of our currency to gold at a certain rate. And everyone knows, because we watch these same monetary planners do it with their paper currencies over and over and over and over again. They draw this line in the sand. Do you have Bugs Bunny cartoon in Holland?
Yeah.
Do you remember the episode where, I don't know if he was up against Yosemite Sam or somebody like that, but he says, "That's it. You won't go over this line." And he with his foot, he draws a line in the sand. And then he steps back. And of course, Yosemite Sam immediately steps over the line and gets in his face again. And he draws
Yeah.
another line and another line and another line.
Yeah.
And it's kind of comical. If they say that, okay, the Fed, let's say the Fed did it, and they say, we're going to fix the dollar at $2,000 per ounce or some number like that. And as the dollar loses its value, which all the dynamics that cause the dollar to lose its value are still in play. I mean, nothing's really changed. The dollar loses its value, and the market, begins to go to the Fed and say, "Redeem my dollars. I want the gold." Eventually, the Fed's going to say, "Okay, now the new price is $2,500," and they'll just redraw the line. So it's a game where nobody would ever deposit their gold. It's only a matter of whether you want to redeem at that moment or whether you think the price is fair for now. So I just see it as an impossible, quest. If the world wants to go to the gold standard, you have to put gold to work, financing productive enterprise. That was the key to the whole thing. And, I kind of wonder if anybody really wants that. And it has to be multilateral trade. That was the mistake after World War I, is the Allied powers, not only do they get the Treaty of Versailles, which is pretty vindictive, but on top of that, this wasn't really in the treaty. They sort of didn't let Germany participate in multilateral trade anymore. They were terrified of even then, German engineering, right, and German productive prowess with the factories. They didn't want multilateral trade anymore, and they didn't want the finance of multilateral trade, which was bills. And so they sabotaged it before it could, didn't let it work, and it didn't. And it was doomed from let's say 1920 or thereabouts. It was doomed.
Yeah, lots of interesting things you've said there, Keith. So one thing you said at the start is that all the mindsets of all the different policymakers and central bankers are more or less the same, dogmatically Keynesian. But at the same time, we've seen developing nations accumulating gold over time, especially since 2010. So wouldn't that sort of give us the impression that they think differently than, for example, Western central bankers?
It's one thing to say, I think the price of gold is going to go up and I'm going to buy some. It's one thing to say, I see geopolitical risk with, the United States, and I want to hedge my bets a little bit. It's quite another to say, I want to have a free market and money, and I want to let my people move capital in and out freely, and I want to let my people own gold so that way they're not trapped in my fiat currency. Those are two entirely different realms. So yeah, the central banks are playing around with assets on their balance sheet to try to optimize as they see fit. They all have to fund welfare states. If they can get a capital gain in gold, that gives them more hard currency to, switch to buy the votes in the welfare state. I'm sorry, I'm being very cynical, and I realize that I'm speaking to a European audience. Europeans kind of love certain welfare programs, but
I bet most of my listeners are also quite skeptical and critical when it comes to those programs. So speak out, no worries.
Okay. So anyways, I think those are two separate things. I think it's pretty obvious that post-COVID, we're in a different monetary regime. We're in a different kind of gold market than we'd been, let's say, from 2012 through 2018-ish or 2019, arguably. That was obviously a bear market. That was, if you wanted to trade gold, sell the blips. And it's pretty clear now that things have changed. Now we're going to buy the dips market. And it's not that just the gold price just keeps falling. We're now in a market where, even though gold is completely unloved, completely neglected, ignored, buried under a mound of silence, whatever you want to call it. If you watch like CNBC, they have that ticker in the lower right-hand corner of the screen, and it goes through like the NASDAQ and the S&P, the Dow, crude oil, the euro, right? It sort of cycles through a certain set of things. Gold used to be every time through on the cycle.
Yeah,
it's now like every third time through, completely unloved. And here we are with gold just off an all-time high in US dollar terms, and at or making new all-time highs in many other currencies. completely
Which is quite
neglected.
interesting, given the high interest rate environment, that gold is doing relatively well. And it also seemed like the correlation or the link that was there between the gold price and negative and real interest rates has also been broken, because normally with real interest rates going up, then gold should have gone down much more already than it has over the past few months. So how do you explain gold's strength?
So I have a slightly different take, and I think that what really matters for the gold price is not a correlation to interest rates. And Monetary Metals, we put out a gold market outlook every year. We've been doing that, I think, since 2012, or and I was doing it even before the Monetary Metals brand back to 2010. And we have in the past looked at, is there a correlation between various different interest rates, the 10-year treasury, the Fed funds rate versus gold, and also the real interest rate versus what people call the real interest rate. And I can go off on a rant about that, but it doesn't correlate that well. And there's times of anti-correlation, there's times of correlation, there's times when they're just not really correlated at all when you zoom out and you look over long periods of time. But I think that if there is a correlation, my theory would predict the correlation is between if there's a spread between the market rate of interest and marginal time preference. You have to look at the saver ultimately as the driver of this. And if the saver is marginal time, if the marginal saver, if his time preference is violated, then he turns to gold. And if his time preference is satisfied, then he might as well sell his gold and buy bank CD or a treasury bond. And the problem now is, interest rates are much higher, but I think the average saver is thinking that inflation is even higher than that.
Interesting, yeah.
So,
even despite they can get a decent, or they can get like a few percent yield, or maybe like 5% if they buy a 1-year treasury, and even though a lot of policymakers say inflation is now subdued, or it's going the right way and getting towards 2 or 3%, then still quite a few savers would prefer to keep their gold and save dollars or euros for that matter.
Yeah, and they've discovered that there's a risk in the banking system that the world discovered, of course, in 2008. They got punched in the face with that banking system risk, and most people came to believe that the actions of, for instance, Jean-Claude Juncker and Ben Bernanke and others, fixed the problem, which is not true, but people believed it. And very recently you had the collapse of Silicon Valley Bank, which nobody expected, and the collapse of Credit Suisse on your side of the pond,
which quite a few people actually expect, or at least maybe not as bad, but Credit Suisse was of course already struggling for years.
That's right, and now you have Deutsche Bank also looking very wobbly, and I'm not sure anybody knows what's going to happen if Deutsche Bank falls over. I think the impact will be a lot bigger than Credit Suisse for sure. So, you look at this risk in the banking system and say, okay, even if you didn't think the price of gold was going to go up in euros, it might be better to hold gold than a bank deposit denominated in euros, because the bank might fail. And what if the bank is too big to bail? I mean, who has the power? Who has the money to bail out Deutsche Bank if it falls over? And that's a very interesting question. And part of it is you have to understand the technicals of the euro and how it works, and the Target 2 system, and how the various national central banks work. But also you have to look at it politically. Would that be politically unpopular to bail it? Would it be politically popular to bail it? And then you have to look at, do they actually have enough money? How bad would it be when Deutsche Bank were to fall over? And I'm not sure that anybody has a good, clear answer to that just yet.
Yeah. So you basically, then people they choose outside money in order to hedge against the collapse of inside money, or the collapse of the fiat money. But the same then would apply to central banks, who may fear that the dollar system will come to an end over time. Especially developing nations could have that opinion, and that's probably one of the reasons why they are also then adding to their gold positions.
A point that I make that doesn't get a lot of engagement, and maybe it's just too abstract, but I argue all the other currencies are dollar derivatives. Now, leaving aside the arguments for why that's so, if that is so, then when and if the dollar collapses, then all the dollar derivatives would be done before the dollar anyway. They would collapse first.
Like the dollar milkshake theory, like Brent Johnson has also pointed forward.
Yeah, I mean, I see that as an aspect of an even bigger picture, which is I had Jeff Snyder on our podcast.
Oh, nice.
If you know who he is.
Yeah, I had him a few times too.
And I said that all the other currencies are dollar derivatives, and he went even farther than that, and he said there's basically only one currency, which is the dollar, and all the other currencies are local scrip, that are sort of supported or tie into it in some way. And so I don't think there's any way of a central bank that issues and manages a dollar derivative to hedge the risk of the dollar going away. It's one thing to say they're going to hedge the DXY going to 75, to pick an arbitrary number. Sure, okay, yeah, you can hedge that. If the dollar were to fail and literally hyperinflate and become nothing, like the Zimbabwe, then all the dollar derivatives would be swept away anyways. There's no hedging that.
Yeah, and so also it's not desirable then for me, maybe for society or for mankind in the long run, it would be desirable to have a different monetary system. But for the players now active, including all the central bankers across the world who are currently using dollar derivatives, they have no incentive to let the dollar system crash, because it would lead to chaos across the world.
Not to mention the people who are in power when something big fails tend to lose their heads in the revolution that sweeps the new system in. You look at the French Revolution, you look at the Russian Revolution, you look at most of these revolutions, it wasn't good to be somebody who was associated with the previous power system. So absolutely, the people that run the central banks of the world absolutely have every incentive to keep it's a gravy train for them. They like to keep that going. It's if anybody's thinking about a gold standard, they're not in power profiteering off the existing system anyways. But even outside of the people that are in the system, how popular is the idea? If you were to post a thread to Twitter and say, "Are you in favor of moving to a gold standard? Yes or no?" I suspect even if I posted it, and surely I'm a filter, if not a magnet, for people that want a gold standard. I bet if I posted that, it would be more no's than yeses. And of course, and that's not, and I don't have a mainstream audience. The mainstream audience would be 99.99% no, and 0.001% yes. And so we're not there yet from a cultural perspective, but what Monetary Metals is doing, and I don't want to toot our horn in the sense of sign up and become our clients. I just want to talk about what we're attempting to do and why we're attempting to do it. I said earlier that you have to use gold to finance productive activities. That's what generates a yield on it. Yield is what draws the gold into the market. If there's no yield, all the gold will disappear into private hoards, which of course has happened. Nobody knows how much gold there is out there, but it's an enormous amount. It all disappears. Interest is the thing that draws it into the market. Interest is the thing that the whole gold standard, essentially revolves around that. That's what, so what we're trying to do is appeal to people's self-interest. We're not trying to say, ideologically, would you vote for this way or that way? That doesn't really work. And then, of course, people, try to figure out how they're going to get one more penny of public largesse or whatever. But instead, if you say, okay, you've got some savings, would you prefer, parking your euros or your dollars in this bank, taking all of that risk for this puny return in a currency which also has risk, or would you prefer, an interest rate of, let's say, 3% in gold, where you're not taking the currency risk and you don't have the opacity of banking system risk? And by appealing to people's self-interest, what you find, people, I don't want to say they're hypocrites, but people don't necessarily behave when it comes to their own money and their own future. They don't necessarily follow the neat ideological slogans that they've been taught in school. They think a little differently. So we're appealing to self-interest. And if there's going to be a rekindling of the gold standard, it's going to be us or somebody doing that, appealing to people's self-interest and making it profitable, making it worthwhile financially to move to a gold standard. And
but let's but if, for example, through Monetary Metals, I could loan gold to, let's say, a bullion dealer and I would get like 2 to 4% interest rate. Depends, I guess, also on the credit risk of the borrower. But if I would, for example, buy a treasury, I would get in dollars at least, let's say 5%. Of course, then you would say, yeah, but then you have the risk of the U.S. government defaulting. But at the same time, we both conclude that the dollar system is so strong, it will probably stay with us for many more years. So if someone thinks, oh, if I follow my own self-interest, I might as well just go for the 5% yield on a treasury instead of the 2 or 3% on gold.
Well, the first question is, how fast is the dollar falling? And even if the U.S. dollar regime doesn't end, how fast is the dollar being debased? And if the debasement is in your example, 3% on gold, which obviously gold can't be debased. There's no such thing as inflation in gold. And then the dollar is being debased at some rate. If the dollar is being debased at 2.1% or greater per year, then you're better off with the gold at 3 than the dollar at 5.
Yeah, but the gold could also go down in value. Of course, you can still have.
Yeah.
We've seen it, and of course, 10 years ago, gold was going after the previous peak of in 2011, and we had a few very bad years for gold as well.
That is absolutely true, and that's what keeps the mainstream and particularly the most conservative savers out of gold, is the fear of the sure. Gold could easily move $200 in either direction, and 2009 to 2011, we certainly saw those moves to the upside, and post 2011 and 2012, we certainly saw those moves, to the downside. But I think the practical answer to that is that people will put. I mean, even our clients are pretty gung-ho for gold, certainly more than the average person. It's a single-digit percentage of somebody's portfolio. So, if 97% of your portfolio is treasury bonds and or bunds or whatever in Europe, and 3% is gold, most people don't go all in on gold. Even the gold bugs don't do it.
No.
Because of the price risk. Because if you need that money in 6 months and the price of gold is down 10%. You're going to regret the loss, and that's how the system is set up. It's very perverse, but
yeah. And so, for example, you write on your own blog. You have your own Keith Weiner economics website, and also, of course, the Monetary Metals website and the Gold Standard Institute.us. And I think on that side, I read one of your articles from 10 years ago, where you also talk about the financial system that could default anytime soon. I've been in this business also for a long time, and in the alternative money space. And the thing is that, of course, with the collapse of the system has been announced quite a few times, and it's almost like what Keynes used to say: the markets can stay irrational longer than you can stay insolvent. But in our world, sometimes it feels like the market can stay irrational longer than we can stay alive, because it seems like they're able to prop up the system much longer than most alternative economists dare to admit. And in Japan, for example, debt is even much higher than in the West. So could it well be that the current system can go on for another 3-4 decades before it finally crumbles? Or
I've always been extremely reluctant to try to put a time on it. And I'm the first to be critical when somebody says that, there's a very famous guy in the gold space who used to put out this thing in this deadpan voice that, the monetary system is going to come to an end. And it was like July 1. And so I actually said, okay, I set a calendar reminder for myself on July 2 to go to his website. And, on July 2, it had just simply been reset. Now the deadline was January 1.
right.
Yeah. On January 2, I went to the website, and it was reset to, July 1 of the following year. And, so that's kind of a con game to do that and scare people into buying a book or whatever, or gold or whatever.
Yeah.
But I do think that the problem with the system is that it is consuming capital, and capital is precious. Capital has to be accumulated by people working and consuming less than they produce, and then the difference is the savings, which goes into capital investment. The system is perversely incentivizing the consumption of capital, and unlike price inflation, if the problem was just simply prices go up, prices have been going up for over 100 years. they could keep going up another 100 years. And, 100 years from now, they're going to laugh. Oh, a car used to cost 80,000 euro, and now a car is, 800 million euro or whatever. It might be 100 years. But if the problem is that we're consuming the capital we inherited from a better system, then that has a finite end. And that is you run out at some point. And I think we're not that close to running out. I certainly don't see it tomorrow morning or next year. They can be punctuated by existential crises. I certainly think by the Fed hiking rates the way it's done, it's going to trigger another 2008 type thing, and there'll be 2008 type emergency measures. And the amounts of so-called money printing that they will do then will make everything that they've done up until then look tiny. If you look at if you go back to 2008 and you look at how the Fed increased its balance sheet and other measures like that, it made everything before that look like a flat line at zero. If you look at what they did in 2020 and 2021, it makes 2008 look barely like a speed bump. So the next one is going to make 2020 look like a speed bump in comparison. But there's still a lot of capital out there that hasn't been consumed yet, obviously. And so, how long does it go? I don't know. I do know that the rate of destruction, along with the rate, obviously the rate of increase of the debt, which is the deficit, and the debt itself, they're all exponential, curves. They're not just nice linear things, they're exponentials. So how much more time do we have? Impossible to say. Adam Smith, I prefer to quote Adam Smith than John Keynes, because I think Adam Smith was largely one of the good guys and Keynes was pure evil. And Adam Smith said there's a great deal of ruin in a nation, explaining that when a country adopted ruinous policies, you didn't get ruin right away. Things could go on for quite a while. And that was the consumption of capital.
And when you talk about consumption of capital, and how would you define capital then? Like actual capital, like machines, or more like financial capital? Because that can be created at will. So could you explain that a bit more in detail?
They can create the illusion of capital. So something I say that should not be controversial, but is, asset prices are the inverse of interest rates because of the net present value calculation, right? If you have a stream of cash flow that's €1 per year, how do you value in perpetuity? How do you value that? Well, you have to say, okay, you value the euro next year at a discount to the one that's in your hand right now. The bird in the hand is worth more than two, worth two in the bush. So it's okay. There's a discount rate that you discount each future year, and that I argue should be the market interest rate, and that's how basically it works mechanically. So if the interest rate's 10%, then you have a formula that says 1 plus 0.9 plus 0.81 plus 0.72 ... That equals 10. So at a 10% interest rate, a €1 per year or $1 per year stream of cash flow is worth 10. But if the interest rate were to fall to 5%, then if you do the math, it turns out the net present value doubles. So that's how you create free financial capital, putting it in air quotes. All you have to do is drop the interest rate in half, and financial assets double in value. And now suddenly everyone appears, seemingly, the illusion, you have to emphasize these words, to have twice as much capital. And then of course, interest rates hike and all of that capital disappears like so much vapor, which is what it was all along. But while the interest rate's falling, you get the malinvestment of the false boom that the Austrian school talks about, and they understand something that the Keynesians and the monetarists have completely missed. And then I kind of refined it a little bit further and say that an endlessly rising asset price, an endless bull market, is a perverse incentive to convert. And I use the word conversion, at least in the English language. That word has an overtone of like an illicit taking. And that's actually in statute in common law countries. I don't know what it is in the continent, if conversion is as a term or a concept, but kind of an illicit taking. There's a conversion of one party's capital to another party's income, right? So I buy, it could be gold, it could be Bitcoin, it could be shares, it could be properties, it could be 12-year-old whiskey in big barrels. I buy this thing at a price of 100. It goes up to 200. I sell it. Presumably, I take my 100 back. That's my capital investment that I don't want to consume. I have 100 of someone else's hard-earned savings. That's my income. He would never have spent it. He would never have gone drinking and on a yacht around the Mediterranean. But I can, because it's my income. I made money as I conceive of it. And so the more the prices of assets are endlessly rising, the more people get on the game. And people are forking over their savings to buy an asset that isn't doing anything other than they're just waiting for the interest rate effectively to fall so they can sell it to the next guy who's going to fork over even more of his savings than you forked over. So you think you're getting your money back. Actually, you're not. You gave your money away to somebody else who's consuming it. The next guy is giving you his money, which you think of as the return of your money, and then you're spending it. And of course, he's doing that for one reason. He expects the next guy to fork over even more. And so while it's going up, people are consuming, they're eating the seed corn. And so in terms of real, actual, physical, tangible assets, what you see is, cracks in the foundation and paint flaking off of the woodwork. Something I've noticed and written about is in Zurich, and the Swiss are, have a reputation for being truly fastidious. I don't know if you've been in the U-Bahn in Munich, but there used to be a poster. I don't remember what product they're advertising, but it says on Schweizer that they are uber pünktlich.
Right. Yeah.
Overly punctual. So even the Germans are saying the Swiss are absolutely fastidious about these things. And in Zurich, you can see these old buildings where the timber could be 500 years old, and the paint is flaking off. The sun is exposed to the ends of the timbers, and you're getting dry rot in the wood all around these magnificent old buildings, along the river and on the old side of Zurich. And if it's happening there, it's happening everywhere. And I see it in Southeast Asia, where, some big property or mall was built 10, 15 years ago, and you see the rust, and you see all these things happening.
And in your home country, the US, of course, is even worse. And you're currently in Britain, right? And there you also see a lot of that happening. Yeah.
It's everywhere. I mean, in the US, no, not over the last year, but previously there was such an incredible flowing of credit that it almost seemed like, and this is a slight exaggeration, but only slight, people would rather build something entirely new than maintain something that was good, for decades or a century.
Yeah, and the main cause of all that then is the boom bust cycle, and the fact that governments are manipulating interest rates and thereby basically motivating people to become gamblers and not take care of their own and their infrastructure and their economy.
Yeah, I mean, as the interest rate falls, it becomes harder and harder to make revenues. So maintenance and upkeep and little capital investments like a new roof or a new air conditioning system become harder and harder financially to justify. But as the cost of borrowing falls, it becomes easier and easier to justify building something completely new. It's very perverse. And yeah, you absolutely see it in America, where you see these, they call them McMansions, named after like McDonald's, like you have a Big Mac or whatever. You have this house that's 5,000 square feet or something like that, which is enormous. I mean, even by American standards, that's pretty big. And you look at it, and it's flimsy slapdash construction, and big empty drywall boxes are for the rooms. It's ugly. There's nothing about it that's pleasant, but it's massive and relatively cheap because of this ridiculous boom. That fueled with I point to falling interest rates for all of it.
Yeah, so we had this boom phase, and we had falling interest rates. Now we see interest rates going up again, but the bust is not yet really visible. I mean, if you look at unemployment figures, house prices, of course, house prices are falling here and there. But if you look at the stock markets, and especially if you follow your line of thinking that with higher interest rates, then the discounted cash flows would be smaller, and the market caps of companies would be smaller. But we see stock markets going up. We see the bust not yet. How would you explain that?
Well, even the proponents of this kind of monetary planning admit to variable and sometimes lengthy lags. And I've written about a few of the causes of these lags, and one of which is, let's say you take employment as an example. How many times has there been the threat of some sort of little bust, either rate hikes or a problem in the economy since 2009? I mean, in the US, I think I can recall at least 3 or 4 where something seemed like it was going to happen. And so what companies were trying to do, especially when they were still stinging from the lesson of 2008, where they were over leveraged and had too many employees and all these problems, is they would try to get ahead of the downturn. But if you're running a major corporation, you want to do the layoff at the first sign of the downturn, and then you want to hire and grow at the first, when you hit the bottom. So they would try to lay off people. But then when the Fed would turn on the juice even more, and you didn't get the downturn, any company that had done layoffs was burned.
Right.
And they were going back to the people that just laid off and begging them, would you please come back, and giving them huge bonuses and doubling their salaries, all kinds of ridiculous things going on. And they really regretted it. And so it was once burned, twice shy, except they were burned 3 or 4 times. So now that you have something that really is real, they're sluggish to respond to it because of how many times they've been burned in the last 5 or 10 years. But at these interest rates, a lot of things break, and one of which is CFOs can't so easily justify borrowing to buy their own shares. Right? When the interest rate when the Fed funds rate is effectively 0, or the ECB rate is effectively 0 or negative, then if you're a AA corporate credit, you're borrowing at under 2%, for let's say 1 or 2 year maturity. It's pretty easy. I mean, the stock price has to get very, very, very high where it doesn't make sense to borrow and buy your own shares, because you're getting a higher yield on your shares than you are paying on the borrowed money. Well, now, these interest rates, it doesn't work anymore. And so I kind of liken it to, if there's another cartoon that most Americans would have, my age certainly would have grown up with, which is Wile E. Coyote.
Yeah.
Runs off the edge of the
So he's
cliff,
hanging
right?
in midair, and
he doesn't fall until what? Until he
Right.
looks down and knows
Yeah.
that he's standing in thin air, then he falls.
Yeah. So
And
it's a matter of time before the entrepreneurs are going to look down and eventually fall. But perhaps they're expecting rates to be lowered soon enough in a very fast pace, and then we're going back to the old boom years. Is that something they may also be expecting, and could that happen also?
are the managers of let's say public companies? I guess the people that are speculating in the stock market are different psychology, but I would not think that too many major corporations, most of them would have economists on staff. I mean, the major corporations certainly would. I wouldn't think that too many major corporations, either the CFO or the economics department, would be betting on, oh yeah, rates are going to fall soon enough.
Well, they look at yield curves, right? They see that the yield curve is inverted, so they expect and the long-term yields are already low, so they expect short-term yields to go down as well. So maybe they'll wait a bit longer before they start investing again, or they're quite positive about the investment climate going forward with lower rates.
Yeah, I don't know. I think the mainstream, I'm trying to summarize the mainstream view, which isn't necessarily my own, and that's a difficult, task for anybody to do. I think if I were to try to summarize the mainstream view, when they look at the inverted yield curve, they think that's a harbinger of a recession.
True.
That's not necessarily predicting that rates are going to fall. That's my argument. That shows rates are going to fall. They're too high. Nobody can afford to borrow at these rates. Are we disconnected?
Yeah, you're back now. Yeah, we're briefly there was a freeze, just a few seconds, but now you're smooth again. Yeah.
So I would they be thinking that it predicts rates are going to fall? That would be my argument. That the reason why the long end of the curve isn't rising is because there's no business who wants to borrow to expand at these interest rates. But I think the mainstream just says, well, it's a harbinger of recession, and therefore now's not the time to be staffing up, or now's the time to do a layoff, I would think. And some of them are starting, but they're relatively small, so far, and obviously it hasn't hit the unemployment numbers yet.
Yeah. And then one thing I also want to discuss more is that, like, in what kind of circumstances a gold standard could arise. Because at first you said, well, currently there, even if they would start a gold standard, there's no trust amongst the public to expect our policymakers to respect the standard and to adhere to it. So you would actually, it's almost like you need a sort of a crash first and an opportunity to start anew, to have and then if people come together voluntarily and use their own monies, probably including gold, set their own interest rates, and have a gold standard like that. Do you agree that you need sort of a fertile ground, maybe after crash, in order to implement something like that properly, like you try with monetary metals?
Well, I was going to say, I'm a big believer in an entrepreneurial, private, enterprise version, and not a, politicized policy decision. So, if you deposit your gold with, any vault or depository, I'll leave monetary metals out. You guys have a storage program. Other companies have storage programs in other countries. The people that are depositing their gold there are relying essentially on contract law to be enforceable. That, hey, I deposited 10 of these philharmonicers with you, and I have a right to get my 10 philharmonicers back. And if you don't give them back to me, then the government will impose consequences on you for taking my coins. As long as people trust that, then a private party can succeed in doing that, versus a central bank that says, today the gold price is going to be fixed at 1900 euro. Yeah, but what is it going to be tomorrow? There's no way to know that. So it's bullshit. But I think, getting back to what is the real virtue of the gold standard, is that it doesn't allow for a political and politicized slush fund that, an honest bank in the gold standard, it has depositors on one side, those are the bank's liabilities, and then it has assets, which is, loans and bills and whatever, to productive businesses on the other side. And if the government comes along and says, okay, well, we want you to give, 1,000 ounces or $1 million or whatever to, support this, politicized, project that has no hope of a return, we're going to tear down, maybe I'm going to ruffle some feathers at risk of saying this, but we're going to tear down all the nuclear power plants, and we're going to instead build unicorn farms so that we can harvest their breath and their farts. We need you to donate $1 million to that, or €1 million to that. In a private bank that just has a simple balance sheet like that, they're going to say, we don't have any room for that. All this money represents the depositors. It's their money. If they want to donate, you're free to ask our depositors to donate to your cause, but you can't twist our arm and make us give it. That would make the whole bank and the whole enterprise unsound. So that's the gold standard.
And then a gold standard would be really like a private standard where all these types of companies would be connected, working together, or perhaps being on one platform in order to make it work globally, but there would not be any government interference there.
Yeah, that's right. And the moment the government interferes, they start to, it becomes a politicized decision-making process, and they start to twist the arms of the banks, which then makes the whole thing unsound. And then the government then has to come in and say, we have deposit insurance, and we have bailouts, and we have all these other things, and bit by bit by bit, it's corrupted into the form that we all know and love today. That's not how it started, but if you're looking for something for nothing, and that's really kind of the political holy grail, to get something for nothing. So, what politicians have discovered, and this is a long time ago, certainly not new, is that the voters love free stuff, but they don't love taxes necessarily. Some voters do, but a lot of voters don't. So if you can borrow instead of tax, then it seemingly offers, again, it's that illusion, seemingly offers something for nothing. And the gold standard stands in the way of that, especially a private gold standard with private banks. There's just no room for that. A bank is a very simple enterprise that it does what it does, and if it does it well, it's not that hard to do it. It's not rocket science. There's no room for, a slush fund for whatever politically correct or woke project of the day, there's no room for it. And that's why ultimately that, as we turn into the 20th century and socialism as an ideology was on the rise. In the United States, it was called the progressive era, and it was anything but progressive. But leaving that aside, of course, they attacked the gold standard, and then ultimately forced its abandonment. And in Europe and different countries, different things at different times, obviously, but the same net effect. So when do people stop, reaching for the unearned? When they look for the government for manna, free manna from heaven, that's when ideologically people will say, yes, let's have a gold standard. And getting to bring it full circle, I don't see that in Russia, China, Brazil, India, South Africa. Those would be the last places that you'd expect that sort of development.
These governments have no incentive to shackle themselves, to restrict themselves. So for them, buying gold is purely as a geopolitical hedge, but not as a precursor for the people to basically run their own private gold standard in the future.
Very well said.
Yeah. And what about other options? Like, of course, the world has changed ever since things like Bitcoin have been introduced. I've experimented with that a lot. I like it. How would you expect some of these cryptos to coexist with a private gold standard, or you expect them to compete, or what's your take on that?
So I had a debate. I was a participant in a debate sponsored by the Soho Forum. So Soho Forum is I think a project of the Reason Foundation and affiliated with Reason Magazine. So the debate was, the way it works, it's sort of Cambridge rules. There's a proposition: gold is going to cease, or gold is going to continue to be relevant 100 years from now, or something like that. But I wanted a broader topic, and I kind of argued the topic that gold is going to work and become the next monetary system, and Bitcoin it's not money, and it doesn't work as money. And if you look at finance productive things, what business could borrow Bitcoin? I mean, if the Bitcoin's proponents are right, the price of Bitcoin is going to be $1 million. So anybody who borrowed it when its price is $25,000, their debt just went up 40 times. They're ruined. So it's not borrowable for anything productive. Now, for several years, people were saying, Keith, you're wrong. Look at Celsius. Look at all these platforms where you can borrow it. But as the price came down, it became very clear that these platforms were not borrowing to do anything productive. They were borrowing to buy more crypto. So as long as the crypto world, the prices were all going up, everything was fine, or seemed to be fine. And then when prices, came down or crashed, it all blew up. It was a Ponzi scheme. Similarly, Bitcoin isn't really suitable for savings. And so in the debate, I said, okay, if you want to talk about savings, let's take an 87-year-old widow who has no further income potential in what's left of her life. Husband is dead. That's it, in the free market, and everybody there. This was hosted physically at the Mises Institute in Auburn, Alabama. There wasn't necessarily a lot of support for any kind of welfare programs there. I'll just say that. So she has to somehow assure her own, grocery bills can be paid for what's left of her life, which could be 10 or 15 years. I mean, if you make it to 87, your life expectancy is probably 100. I don't know. So can she put all of her money into Bitcoin? And I said, if Bitcoin is capable of falling from $69,000 to $16,000, that is an unacceptable loss to somebody who's 87 years old and can never earn any more money. And so I framed it rhetorically. What would you argue that Grandma Mildred should do if that happens? And my opponent in the debate was Pierre Rochard, Bitcoin Pierre on Twitter, and he said, buy more Bitcoin. So he said this in his final rebutting remarks, and the rules of the debate are: I'm sitting there seated on a chair on the stage. I'm not allowed to say anything anymore. But I found that statement to be so outrageous.
Yeah, but she can buy Bitcoin because she has no cash flow, right? So.
Well, right. So I just went like this to the audience and just kind of made this face, and then the moderator, Gene Epstein, who's sitting to my right, is kind of like you know, it's like, you know, he's kind of motioning to me, if this
Yeah.
is against the rules. And anyway, it's all caught on video. And, you know, and I'm just kind of shrugging, like, sorry for cheating. But, you know, I had to visually respond to that statement because that's just so absurd that obviously Bitcoin does not work for an 87-year-old widow. And, you know, as you said earlier, you know, gold has a price risk, but Bitcoin's price risk makes gold look you know, unmoving, you know, by comparison. Now I argue gold actually doesn't move. It's the dollar that's moving up and down.
But one thing that you said about Bitcoin, that's if we indeed go to this private gold standard, then also gold could have this huge price explosion upwards, right? So if you now borrow gold and we go towards a private gold standard, wouldn't, yeah, of course, if you're completely if everything is denominated in gold, then probably the problem doesn't arise. But if there's a chance that gold in that scenario goes times 10, for example, and if you then borrowed gold and you have to get the gold in order to pay off your loan, then you still you have the same kind of problem.
My argument is that gold doesn't go up 10x. If the price of gold goes to $20,000, it was the dollar that fell 90%, not that gold went up. And that gold is actually stable. And the very first thing I did, I only had one chart. I mean, we were allowed to use slides in the debate if we wanted. And I had one slide, and it was a slide saying the price of gold over 5,000 years. And it was a flat line labeled 1 ounce. You know, the price of an ounce is 1 ounce. And I said, okay, look, you could treat this as a trite tautology, you know, 1 = 1, right? But
yeah, Bitcoin would say the same thing, right? So
yeah. But what I'm saying is actually something different, which is that if you look at the concept of marginal utility, what is a unit at the margin? What is the nth plus 1 unit of a good worth in relation to the previous unit? So the nth plus 1 unit's value divided by the nth unit value. And I argue that, and I don't have to make this argument, Menger made this argument, and Mises made this argument, that it's diminishing for all normal goods. So if you start to accumulate an excess inventory of wheat, copper, oil, whatever, the price crashes. It's called a glut. But if you take a look at gold, there's no such thing as a glut. It's not possible to have a glut as such in gold. And why? Because the marginal utility isn't falling. What's the proof of that? The proof is that we continue to accumulate gold without any apparent limit. And at the time of that debate, I said 5,000 years. It actually came out relatively recently that they had a find in Bulgaria where some warrior king was unearthed. He was buried with something like 7 kilos of gold 6,500 years ago. So as far as we know, mankind has been accumulating gold for at least 6,500 years and valuing it and continuing to accumulate more. If there's any diminishment of its marginal utility, we haven't found it yet after 6,500 years of accumulating. Its marginal utility is a flat line, which means the nth plus 1 unit of gold is valued the same as the nth unit. And so it truly is a 1 = 1, which is not true for Bitcoin. In fact, Bitcoin's creator was so afraid, was terrified that its marginal utility would fall, that he built in programmatically, algorithmically, a strict cap at 21 million. Gold has no such cap, which of course the Bitcoiners argue is a bug, not a feature. And I argue that's actually the principal feature of it, is that its marginal utility doesn't fall. And so the gold mining continues to this day, and the gold miners produce some 3,000 tons a year of new gold added to all the existing gold, and the market readily gobbles it up without you know, denting the price.
you're not afraid of asteroid mining?
Asteroid mining, I'm afraid of lousy economics of the sort that goes into those sorts of stories becoming policy. That's what scares me. And I'm not afraid of Uganda allegedly having $1 trillion.
No, that was bogus. Yeah, that whole story was fake. Yeah.
Just like, you know, everything else that comes out of these kinds of tin pot, you know, dictatorship type countries.
Yeah. But at the same time, we then need to make the circle completely round. Is that the BRICS story probably also was bogus? Then, like you're not expecting an announcement next month that they're going to be a gold-backed BRICS currency. Then,
I mean, No, it's certainly not as the way the story is circulating in the gold community on Twitter. Absolutely not. I think that these countries, and particularly Russia, has a real problem, which is they're locked out of the dollar clearing system, and not just the dollar. I mean, SWIFT is broader than that. They're locked out of that, so they need something. And Russia was doing trade, or does trade with India, obviously, and it came out of some Russian official, I don't remember who said this, that basically we've accumulated these useless, worthless rupees. We're not going to be doing this anymore. So if they were allowed to use dollars, they'd be using dollars. And so they ended up trying to get rupees, but the rupees worthless to them. And so what currency are they going to take? Well, they need some sort of settlement mechanism. And so they're struggling, come up with something. And maybe they use gold to settle the delta. So, okay, Russia sells this much to India, India sells this much to Russia, and whatever the difference between the two is, somebody has to
That makes sense. Yeah.
physically transfer gold. And so they can end up, in a certain sense, backing into gold. It's kind of a little appreciated argument about the gold standard. The gold standard was not a bunch of European countries sitting down in the 19th century and agreeing to use gold. And if you look at the history of that, at that time, there was anything but agreement. There was basically chronic war at that time in Europe. And so they didn't use gold because they all agreed on it. They used gold because there's nothing else they could agree on. And gold requires no agreement. If I hand you a piece of gold, from the weight of it and the color of it, gold is unique. You can tell it's gold immediately. Gold is so much heavier than it has any right to be, right? And so they used gold because they didn't trust each other. They didn't like each other. But, this region produced this, and this, Germany wanted wine, and maybe Italy wanted beer or whatever, so they traded. And that's how it was.
Yeah, and you could argue that we're perhaps are seeing the same types of conditions again. Not so severe yet, of course, but there is a lot of distrust amongst nations, especially East versus West and North versus South. So possibly if things heat up a bit more, then and people's countries trust each other even less, then gold is basically the only
Right. So
currency they can use.
In that sense, they can end up backing into and evolve over many years. It certainly wouldn't be instant,
Right.
but backing into sort of an element of the gold standard, which is clearing and settlement. And it'll be very inefficient because all the gold is going to have to be physically transported back and forth, by truck or plane or whatever it is, at least initially. And then somebody starts to get the idea: what if we had a clearinghouse? Then we wouldn't have to keep constantly shipping this stuff. Yeah, that'd be a good idea. And then what if we could draw bills on our drafts on our gold held in the clearinghouse, and bit by bit, the elements, but probably not the Russias of the world, and in India in its current form, South Africa in its current form, Brazil just elected the socialist Lula. It wouldn't be countries like that would that would create it. As in the 19th century, it was England. It wasn't Italy or Germany, or there wasn't even a Germany in most of the 19th century. There was Bavaria and other different, Prussia and different kingdoms. The same thing. It's if that kind of a mechanism is going to evolve, what would be the likely countries that care enough about the rule of law and are willing to be honest, even when it doesn't suit their immediate short-term gain?
There's no candidate at the moment then.
That's the challenge, is who's the candidate. And there's elements of that in Dubai, there's elements of that in Singapore, there's certainly elements of that in Switzerland, there's elements of that in the UK, there's certainly plenty of elements of that in the US, although less and less the US government. But the American culture is still by and large one of decency and honesty.
Would Trump be someone that's, because he talked about it in the past, right? About gold, and he seems to like gold. Is he someone who could usher in such a new system or era?
There's a video of him where somebody was talking about the negative interest rates in Europe at the time. And he said, negative interest rates, I want some of that money. Give me some of that free money. And then a couple of people in the audience clapped. He said, yeah, you see, the smart people are applauding. Free money. And, if you watch that, it's hard to square that circle with, oh, yeah, what's the gold standard? So he did, to his credit, And I consider Judy Shelton to be a friend. I know her. He did nominate Judy Shelton to a position at the Fed. Now, unfortunately, the Fed is not a legitimate institution. And if you really want to reform the system and move to a gold standard, you wouldn't do it from within inside the Fed. It's just the wrong, you'd have to do it from within Treasury. So he should have nominated her to be Treasury Secretary, not on the Federal Reserve Board. And of course, even the Republicans, and the Republicans had a majority at that time, couldn't really get their arms around having Judy Shelton as anything in the Fed. That was just, too radical for them. And so her candidacy, never went anywhere. It was political, dead letter.
Right.
And so even if Trump wanted a gold standard, which I don't think he would, you can't have one person impose, even if it's a good thing, you can't have one person try to impose it. The political system it's designed to be very conservative. It's designed not to be easy to change, which is largely a good thing. But then if you're trying to impose a good reform, it's frustrating.
Right. Yeah, so we're going to see then the years ahead of us what's going to happen with the system and with the different monetary alternatives. But I'll keep on following you, Keith. I found it very useful and interesting to talk to you. Where can people find more about you? You have a bunch of websites. Could you? I'll also put them in the show notes. But what's the best way for people to reach out to you?
Our company website is monetary-metals.com. My personal economics blog is keithweinereconomics.com. On Twitter, I'm at Real Keith Weiner. Although at the moment this is being recorded, I'm in Twitter jail for 7 days.
Oh,
So
what kind of offense?
I've written a little bit about AI and how stupid AI really is. Ironically, I think that's the top article on my personal blog at the moment. So somebody was saying value is subjective, and I said, try drinking gasoline and eating lead, ! I.e., it's not subjective, not in that sense. It's not anything you want it to be. Anyways, they flagged that as, or their AI detected that as, I'm encouraging somebody to self-harm.
No way.
I gave you this whole warning about if you're feeling suicidal thoughts, call this hotline and all this shit, and your account is locked for 7 days, unless you, or you can appeal it, during which time you can't even do private messages or anything. And if you accept the judgment and delete the post, it's very sort of Orwellian or Solzhenitsyn. They want you to confess and delete your post, even though they've already deleted it for you anyway. And then they give you a 7-day, clock ticking down that, will restore your account privileges. So the moment I'm locked on Twitter for, I guess, 7 days. I don't know how long this is going to go, but at Real Keith Weiner on Twitter. And those are my, my company site is the principal one, my personal blog and Twitter. And then I'm on Facebook as well, but that's more for just friends and
Right. Yeah.
cat pictures and stuff.
Facebook is kind of dying here in Holland anyway. So
yeah, I think both of them are dying, and I think both of these platforms shot themselves in the foot. They're stupid policies, but
yeah, it would be a pity if Twitter would die because I use Twitter a lot, and I still find it very useful to curate my own feeds and to make sure I get the right things to read and to watch. So that would be a big pity, but hopefully they can still change the tide. Changing it to X was not really a very smart move, I think, but
hopefully I'll be back on Twitter in 7 days. But what can I tell you?
Yeah. Well, thanks so much, Keith, and let's stay in touch.
All right, thanks, Paul.
Okay.